So picking up from where we left off in the last video, we're going to be looking at depreciation and how to exactly calculate the depreciation for on straight line method, right? So remember we said that depreciation on straight line method is calculated at cost multiplied by the depreciation percentage. Now for straight line method, it never changes. It is always this calculation, right? So I have an exercise here for us whereby we're going to be looking at how this actually looks like. So we're going to calculate the depreciation for every year, then the accumulated depreciation. Remember that the accumulated depreciation is all the depreciation added together. So depreciation for year 1 plus year 2 plus year 3 and so on and so forth. So as long as the asset lives, the more depreciation it has. So think of it as your age, right? As your age. This year you are 10 years old, and then you lived another year, right? So it's gonna be now 11 years. The next year you going to live another year, then it's going to be 12 years. Then the next year you another year, and so forth, and so on and so forth, right? Same thing, accumulated depreciation. Whatever balance that you had, you add the depreciation that you had for this past 12 months, this current financial year, and then you have your accumulated depreciation for the next financial year, right? Then our carrying value is our cost minus our accumulated depreciation. So by carrying value, we mean what is the value that we put on this asset, right? If we were to sell it today, what would we reasonably expect, right? So if you have a phone that is 2 years old, you don't expect to sell it for the same price that you bought it for. So if you bought it for 10,000, you're not going to sell it for 10,000. You're going to sell it for, say, 6,000. That is what you think is fair, and we would consider this the carrying value. So from this 10,000 to go to the 6,000, we would say that you accumulated depreciation of 4,000. You get me? So it was cost minus accumulated depreciation gives us carrying value, right? So with having the basic terms out of the way, now we can actually calculate this whole scenario, right? So here we have BS Builders purchased a second-hand caravan to accommodate their 4 staff members while working on building sites far from their homes in Durban. This asset is considered to be part of their vehicles that is taken to building sites. The business financial year ends on 31st July each year. So here I want to just bring you attention to the main things that we need to understand. We need to understand our cost price, must understand our depreciation method. So here they're saying diminishing balance, but we're going to do that in the next video. For now, we're just going to use the straight line method, right? I want to bring your attention to the depreciation rate and the date that it was purchased. Also, finally, the date that it was sold, right? You must know the date that it was purchased and the date that it was sold on, right? So the easiest thing, the first thing that I would suggest that you always do is drop a timeline, right? Drop a timeline so that you understand when how old this asset is and how the financial year goes, right? So one, we have the date that it was purchased, so that is 1 August 2014. Then we have the end of the financial year. So end of financial year, each year they tell us that it is 31st July every year. So we're going to say the next year that ends on the 31st of July 2015, right? And then we know that the end of the first financial year is the beginning of the next financial year. So if it ends on 31st July, on 1 August 2015, the new financial year starts. And that financial year ends on 16 July, no, sorry, 31st July 2016, right? And then that financial year ends on, let me just extend this. That financial year ends on 31st July 2017, right? But when was it sold? The asset was sold on the 30th of January 2017. So 2016, 2017, maybe somewhere around there. 31st, no, 30 Jan 2017, right? So this asset existed in our business from the 1st of August up until the 30th of Jan, right? Now, another thing that you must understand is how long was this in our business. So for the first year, a full 12 months. For the second year, a full 12 months. And then for here, it was 6 months. So now you know how to what the time period is that we're working on to calculate depreciation, right? Then now we start with the actual calculation. So from the first 12 months there, we're going to say on 31st July 2015, let me just write the year, right? 2015, our depreciation was as follows: cost price, remember that's important, right? Our formula again, cost price multiplied by depreciation percentage. So cost price is 80,000 multiplied by our depreciation rate is 20%. And remember, this activity we're doing straight line and not diminishing method, so our answer there will be 16,000. It's going to give us 16,000, right? And then this is the period from 1 August 2015 14 I mean to 31st July 2015, right? That is that. And then the next year, just gonna remove that first part, the next year was for 12 months once again, right? Always note how long it is for. 12 months, so I'm just gonna say 80,000 multiplied by 20% equals to 16,000 once again, and that is for the period from 1 August 2015 to 31st July 2016, right? Then finally we have our last period from 31st July up until 30 January, and this is 6 months. So when it's 6 months, we have to classify or specify that it is for 6 months. So it would be the same formula, the period, the actual calculation multiplied by 6 over 12, and this would give us and that would give us 8,000, right? 8,000, and this is from the period of 1 August 2016 to 30 Jan 2017, right? Now, what is your accumulated depreciation every year? Filling this in, I totally forgot about this. Filling that in, we know that our depreciation in the first year was 16,000. depreciation in the second year was also 16,000. Then depreciation in our last year was 8,000. Now accumulated depreciation, we said that it's the balance plus the depreciation that happened in that year. For the first year there was no balance, so it's going to be 0 plus the accumulated depreciation for that year will give us 16,000. Now our carrying value here is going to be 80,000 minus 16,000, and that will give us 64,000, right? So 64,000 right there. Then we move on to the next year. The next year is going to be 16,000 plus 16,000. Remember, calculating accumulated depreciation, this was carrying value. Calculating accumulated depreciation is our balance, this was our balance, plus the depreciation for that current year. So we're gonna have 32,000 rand there, 32,000 rand as our depreciation for the year. And then the carrying value for that, is going to be 80,000 minus your actual accumulated depreciation, which is now 32,000. Remember, every year that you have depreciation added again and again is that you subtract the full accumulated depreciation from the asset. So then it's going to be now 48,000 rand. Then we fill that in as our accumulated depreciation of our carrying value of 48,000 rand. Now for the final year, our accumulated depreciation is, remember, the balance, which is now 32,000 rand, the new amount of 32,000 rand, plus our depreciation in that year, which is 8,000 rand, and that gives us a new accumulated depreciation of 40,000 rand, right? And then finally 40,000 rand. Finally, we have our carrying value of 80,000 rand minus all our accumulated depreciation on this asset from the day it was bought up until the day it was sold. So all of this depreciation here is worth 40,000 rand that took place in this period of time. And here on the end, here at the end, our carrying value on this asset on the last day will be 80,000 minus 40,000, and that will give us 40,000. So this is the carrying value of this asset at the end of the 3 years, right? And then we have it there, 40,000 rand. Now this is how you calculate depreciation on straight line method. You can see it as fairly simple, it's fairly straight, no pun intended. There, 16,000 rand, 16,000 rand again, and then 8,000 rand at the end, right? The only reason it's not 16,000 rand at the end, once again, is that we did not keep the asset for a full 12 months, hence we show it there, right? We only kept it for 6 months out of 12. Now hopefully this video was able to assist you. If you don't fully understand how I got to those answers, those numbers, everything, you can rewatch this video and then make sure that you understand this, right? And then moving on, we're going to be doing on diminishing method, right?